We have a new Federal Reserve Chair nominee. What does that mean for the greater economy? What does that mean for commercial real estate? Let's dive into the nomination of Kevin Warsh and get into what we might be able to expect over the next couple of years from the Federal Reserve.
Welcome to the Secrets to Abundant Living podcast. Your guide on this journey is Amy Sylvis, ready to unlock the keys to a life of true abundance. We're diving into everything from financial freedom and optimal health to meaningful relationships, geographic freedom, and everything in between. It's about creating a life rich in experiences, purpose, and joy. Get ready for empowering conversations, expert insights, and real-life stories that inspire you to live abundantly. If you're ready for the secrets to an abundant life, hit that subscribe button now, and let's get started.
Hey everyone, welcome to another solo episode of the Secrets to Abundant Living podcast. It's great to see you. We're already in February of 2026. Time is flying, all the cliches, right? I am grateful to see you all here. Thanks for joining us. As you may have noticed, the Federal Reserve, or Trump, nominated a new Federal Reserve chair. He hasn't been confirmed, so it's just speculation at this point. But I do think it's worth us talking through what Federal Reserve chair, a potential Federal Reserve chair of Kevin Warsh, could be like for the economy, for commercial real estate, all of the good things. And it's so funny, this name, growing up in Los Angeles, we knew a number of people from back east, specifically Pennsylvania, and they would say instead of wash the dishes or wash the laundry, they would wash the dishes and wash the laundry. And now I'm going to think of that every time I hear our potential Federal Reserve Chairman's name. Just a fun throwback there, I guess. But in all seriousness, Jerome Powell's term, I think, expires this May. Obviously, if no one is confirmed as the next chair, Powell will stay as the chairman. But it is worth looking into how might a Warsh chairmanship look and shape the economy and shape commercial real estate specifically, or any investment for that matter. So as we all know, or as a reminder, the Federal Reserve is a democracy of sorts. So the chair isn't unilaterally making decisions. So obviously the Federal Reserve chairman sets the tone, sets direction, is, part of the leadership, but they don't unilaterally make decisions. So, the nomination is important. Obviously it has impact, but it isn't going to, be a dictatorship, as it were. A Warsh or a Powell dictatorship. The other people that sit on the Federal Reserve are still going to have their votes as well. So, but let's take a look, because these solo episodes, to remind you all, we talk about abundance in terms of hands-off income, and that hands-off income can come from dividends from stocks, can come from clipping coupons from bonds, private lending, obviously commercial real estate, which is something I invest in and my investors invest alongside me for passive income. So our outline are really taking a look at the three changes, or the three kind of highlights from a potential Kevin Warsh chairmanship. And so the first thing is the Federal Reserve is very data driven, as most of us know. If you don't know, now you know. But to quote Marco Rubio there, so they're very data dependent, and that data is backward looking. Doesn't mean that they can't forecast, right, moving forward, what the data could mean statistically speaking. But Warsh has been really outspoken about having a more forward-looking strategy. The Fed, objectively speaking, has had some bumps in the road where they've been late to raising rates and have been late to cutting rates. So Warsh argues, in some sense, that data dependency of that backward-looking data makes them a bit more delayed. So having a forward-looking strategy on things like productivity gains that is seen in the economy that may cause the economy to grow faster, and really have a future projection, he believes could be a better focus for the Federal Reserve moving forward, which would be a change from how they currently utilize data. Yeah, how they currently utilize data as the Fed. So it could mean that rates might come down this year or sooner than they would if they're seeing instead of the rear view mirror, they're seeing in the windshield that there are likely some economic problems coming. They might not wait for that to show up in the data. They might anticipate that, possibly. We're just guessing. Obviously, he's not the chairman, so we don't know that for sure. He's also in favor of deregulation. So specifically deregulating the banking sector, which could have positives and negatives as well. So I hate to be a bit more kind of wishy-washy here, but in terms of commercial real estate, about 70% of commercial rate debt comes from regional banks, which is interesting, which is for those of us who do invest in real estate, it's an interesting kind of point there. And regional banks specifically have been lending less in the commercial real estate space because of strict capital requirements. So for those who aren't familiar with real estate specifically, the more lenders are in the area, the easier it is to be able to get debt for real estate. Usually the more liquid the space is, and that can make it easier to buy and sell real estate. Some would say increased liquidity, increased transaction costs may make valuations go up. Again, there are a lot of factors that go into liquidity and, of course, real estate valuations. But from a real estate valuation lens, if we have more deregulation in the banking sector, specifically in the regional banking sector that provides so many loans to commercial real estate, it's possible that this increased liquidity could increase prices. Again, I'm being very strategic with not being absolute with any of this. There are definitely lots of factors that can go into this, but important to talk about. The third thing, in addition to being less data dependent, more forward looking, that's one. Believing in more deregulation, that's two. The third is the topic of quantitative easing. The Federal Reserve Chair, potentially the nominee, Kevin Warsh, doesn't have unilateral ability to do any of these things, but he is very against quantitative easing. A lot of us remember the Fed really pumping out money after the 2008 financial crisis. He was a very, very vocal critic of that strategy and is in support of shrinking the Federal Reserve's balance sheet. So this idea of the opposite of quantitative easing is quantitative tightening, and that reduces the Fed's balance sheet. That could put long-term Treasury rates higher over the longer term. I said that twice. Long-term rates for Treasuries could be higher. Typically, shrinking of the Fed's balance sheet means less liquidity. Less liquidity could tend to make interest rates higher. So that might be something that we're facing in the United States. He has also been vocal, though, about wanting short-term rates to be lower. He thinks the Fed has been too slow to cut rates in this cycle right now. So in the shorter term, he's been vocal about wanting rates to be lower. In the longer term, he's vocal about shrinking the Fed's balance sheet, which could push up rates. Now, there's always politics involved. So has he been vocal about lowering interest rates to garner favor with Trump because Trump's been really vocal about cutting rates? Very possibly. But again, just because Warsh, if he is nominated, says he wants to lower rates, there are still several other people that sit on the Federal Reserve that have a vote. So it's not just for him to decide. But again, lower rates can translate into keyword, not will, can translate into higher commercial real estate prices, all things equal. So there are many things that go into commercial real estate valuations. Liquidity and interest rates are just one. So we're holding all the other factors constant when we talk about interest rates. So on the whole, what could this mean? Well, it's kind of a mixed bag, right? And don't forget, it was Trump that nominated Powell. Trump's had a lot to say about Powell, especially here in his second term. So there's a lot to think about. But I've got something that I don't hear enough people talking about, and I'm going to leave you all with this. Have you ever thought about having multiple streams of income? Instead of relying on just one stream of income where you're trading your time for money, how would you like to free up more of your time and live a more abundant life? As a listener of the show, you're invited to attend one of our upcoming trainings where I'll give you an inside look into how you can add passive income and get all the other perks of recession-resistant real estate investing without the headaches of being a landlord. I'll also be sharing some hidden mistakes to avoid and the criteria I personally look for when evaluating potential investment opportunities. To reserve your seat for free, go to sylviscapital.com/webinar. Again, that special link to reserve your seat for free is sylviscapital.com/webinar. I look forward to seeing you on the training. And now back to the show. We all understand that the United States has debt, right? We've heard of our national debt. Well, the United States national debt, interest on that debt is now the second largest expense for our government. So we look at government spending on an annualized basis. Number one is Social Security at $402 billion. Number two is interest on the national debt at $270 billion. Number three, very, very close to interest on the national debt, is national defense, $267 billion. So think this through. Interest on the national debt, this isn't productive money, is our number two expense. You pay your taxes. We're all trying to balance the budget. We're thinking of how our government's spending money. Interest on our national debt is the number two expense. Now, follow me here. This is the last point. 33% of our national debt is maturing in the next 12 months. A third of our national debt is maturing over the next 12 months. That's $9 to $10 trillion. $9 to $10 trillion. That debt is maturing in 2026. 50% of the national debt is set to mature in the next 4 years. So that's an additional 10 to 12 million. So that's 21 trillion in national debt maturing over the next 4 years, or 70% of our national debt. This debt will need to be refinanced. That's the whole thing about that debt maturing. So raise your hand if you want to guess if the interest on our national debt is so high and the debt's maturing, 30% of it is maturing in 2026 alone. Do you think first we want the interest on the national debt to go down? Of course. Imagine where that money could go. That money could go to help, Medicaid, right? People that are on the poor end of the economic spectrum, and we could help them with healthcare, with Social Security, with helping our seniors who are fixed income. I mean, this isn't political. I'm just talking about ways we could spend that money, that $270 billion annually that's just going to interest on the national debt. Wouldn't we want to lower that expense? Well, guess how that expense is lowered when we refinance all of this debt, the $9 to $10 trillion in 2026. Raise your hand if you got the answer. Ding, ding, ding. Lower interest rates. Ooh. And will that cause inflation? Probably. But the Fed is kind of backed into a corner because we don't want interest on the national debt to keep going up. Imagine if it becomes our number one expense. This is a spiral that could have terrible consequences. It could, everything is trust, right? The monetary system, I'm not going to get to tinfoil hat here, but it's all trust. And we don't want the trusty United States dollar and the solvency of the government to come into question. So if I were a betting woman, and I'm not necessarily betting, but I am betting with my investments, I would imagine that interest rates, it would be in everyone's best interest with the frame of the debt. I'm not talking about inflation, but in the frame of the debt, to lower interest rates in 2026, to refinance that $9 to $10 trillion and the additional 11 to 12 trillion in the next 4 years. Now, inflation is interesting, right? Because it's not an overt tax, but it is definitely a tax. And sadly, it's a regressive tax, meaning it hits the poorer and those on fixed incomes even harder. But our ability to help the poor and those on fixed incomes is reduced if we keep spending money on interest on the national debt. So I'm just going to throw that out there. I personally think inflation is going to get higher. Not investment advice, not telling you what or will not happen. My crystal ball is not always right. But if I were a betting woman, interest rates will go down. But Amy, inflation, yes, inflation. That's why I'm buying hard assets. That's why I still own gold and silver, why I own commodities, why I own cash flowing real estate, because those tend to do better during times of higher inflation. And hey, even if inflation doesn't go higher, there's a whole bunch of other reasons why I own all those things. Not investment advice, just my own strategy. But I am really curious to hear what you all think about how the government will handle refinancing a third of our national debt in a single year in 2026. If Warsh, if he's nominated, if he's able to perhaps convince, or maybe the other Fed governors already know that rates need to go down for the interest on the national debt. Okay, this ended up going a little bit longer than I expected. Hopefully now every time you hear Warsh, you think of washing the dishes or washing your clothes. You're welcome for the earworm. Hey, if you found this helpful, give us a rate and review on where you listen to the podcast. If you haven't already, we would be so grateful. This is a labor of love, but something we work very hard at. So having your support with a rate and review means a lot. All right, y'all. Looking forward to seeing you on the next episode. Thanks for stopping by. We'll talk to you soon.
Thank you for joining us on another episode of the Secrets to Abundant Living podcast. We hope you found inspiration and valuable insights that will empower you on your journey towards abundance. If you enjoyed today's episode, don't forget to subscribe, rate, and leave a review. Your feedback means the world to us, and it helps others discover the secrets to an abundant life too. Stay connected with us on LinkedIn, Amy Sylvis. Keep striving for your goals, nurturing your relationships, and embracing the adventure that is life. Until next time, we wish you an abundantly fulfilling day.